Ladies and gentlemen, welcome to this special podcast. Today we have a returning guest to the show, Charles Hugh Smith from Of Two Minds, located at of2minds.com. And I got to tell you, home buying season is springing to life. And besides record-setting checkout lines at Lowe's for mulch and pansies, we've got record-setting home prices all across America. But what's really going on in the housing market? Is it good neighbors, well-maintained lawns, and rising home prices forever? Or is the housing market about to crash like it's never crashed before? Well, Yard of the Month winners and curb appeal aficionados, put away the battery-powered lawnmowers and shelf the pesticide sprayers for a moment, because today we're talking to Charles Hugh Smith to explore just what in the heck is going on with the housing market. So, Charles, I'd like to thank you for joining us again on Silver Doctors.
Thank you, Paul. It's my pleasure. And, housing is interesting to all of us because we all have to have shelter, whether we rent it or buy it or, lease it, whatever. And I've been following the real estate market, from like the previous bubble in 2000, the early 2000s. And I think that's actually what created my audience, starting to write about housing and questioning the conventions about, the bubble never pops and, they're not making more land, et cetera, et cetera. So anyways, it's kind of a revisiting topics that I covered before, but it's a different situation now in some ways. So that's what makes it interesting.
That's right. So let's cover the conventions and the confusions. And now, Charles, it's like, right now it's hot to talk about housing all of a sudden. And Charles, there's a lot of propaganda and outright confusion out there. So let me give you a couple really quick examples, Charles. On April 20th, just last month, CNN comes out with an article titled, "Home Prices Hit Another Record High in March." So it's pretty self-explanatory across the country, nationwide, record high home prices. I think it was like 357 or 375. I can't remember the exact number, but you get the point. Then on April 25th, so just a couple weeks ago, Realtor, right? Like supposedly this top-notch source of information comes out with this, I don't know if it's an article or study or what it was, but it says, home prices have begun falling. Here are the cities where they're down the most. And here's a direct quote from this article, Charles, and I quote, "This is not a repeat of the Great Recession when a housing bubble popped and prices plummeted across the country. These are mostly smaller decreases that don't portend another crash." So now, Charles, a lot of the mainstream and media picked up on this article and this Realtor reports, and they started talking about it. And I looked at it and I saw, oh my goodness, Toledo, Ohio, this is #1 for falling more in price than anywhere in the entire country. So, Charles, please bear with me for a minute. People think this is an interview. This is not an interview. This is a conversation. We're exploring the housing market today. But please bear with me for just 1 minute here, Charles, because I want to get into the nitty-gritty of a couple things, because I feel that I could say a couple things about this. Now, we, as in my wife and I, we bought our first house in Durham, North Carolina in 2004, 2005. I can't remember exactly when. It was before my daughter was born, so I know it was before March 2005. We sold it in 2010. Now, we bought our second house in El Paso, Texas in 2012, April of 2012, and we sold that house in 2017. I've lived all across the country in many different states and many different regions for all of my life. We bought in 2017, like we talked about in our previous interview, moving out of the city, getting out of the city while you can. In 2017, we moved our family strategically from El Paso, Texas to Toledo, Ohio, Charles, in 2017. And in 2019, after studying the area and finishing our actual decision on where we were going to purchase, we ended up purchasing our third house in Perrysburg, Ohio. That was in May of 2019, as a matter of fact. So I want to talk about this Realtor article just for superficially, but I want to talk about Toledo and just housing and in general. And I'm rambling, but let me get back on point, Charles. The article states that Toledo, Ohio leads the nation with a decline in 18.7% year over year in housing prices. I just want to say a few things about that, Charles.
Yeah.
Toledo's in Lucas County. Maumee is another town that's in Lucas County that basically kind of like, one street, half of it's Maumee, half is Toledo, and there's probably the line goes straight through a business or house or something. So it's like meshed together. So Maumee is this town in Lucas County. Realtor, same site, says prices have gone down there year over year by 1.9%. But Sylvania, this is another town that's kind of meshed in with Toledo in the same county, in Lucas County. Again, Realtor, the same website, says that prices have increased 12.2% over the last year in the same county, Charles. And then in Perrysburg, now this is Wood County, so I'm one county over from Toledo now where we live. And Realtor's website again says prices have risen 16.1% year over year. And in my zip code, 16.4% year over year. So it's like, wow, that's a huge difference just the next county over, or just the next county over within the same town. And I often joke with my kids, and it's a sad joke really, but I ask them, this is the joke that I made up. And it's not even really funny, but I say, what's the difference between Toledo and Perrysburg? And I say, the difference is in Toledo, people throw trash onto the streets and sidewalks. And in Perrysburg, people pick up the trash from the street and the sidewalks. Charles, it's like, this is like some of the things that I'm seeing. So one more really quick point before the question, and then this will only take a second, is I personally believe that anywhere you go, any area, period, whether it's a house, a city, a region, a state, a country, whatever, it's either on one of three stages. It's either rising, it's either falling, or it has fallen. So one of the reasons why we strategically chose Ohio, in addition to the fertility and the water resources and this and that, was because that I have felt deep inside that Ohio as a whole has already fallen. So it can only get up from there and rise again. So, Charles, specifically, like taking into consideration all this newfound talk about the housing market, this realtor stuff that's coming out that everybody's talking about, like specifically, what does a rising or falling housing market even mean? Like in Toledo, I guess that's a good thing because it means a person doesn't have to pay as much for a house. So that's like good, right? But then just generally, just help us make some sense of all this propaganda and the overt and covert confusion that's taking place in the housing market, Charles. Please help me with this.
Okay, well, I love that question, and I'm going to get that. But I wanted to ask you a follow-up question first, which is you just so happened to have chosen your first two homes in North Carolina and Texas in two of the hottest markets. I mean, states with huge influxes of new residents and therefore strong demand for housing and therefore rising prices. So I talk a little bit about your experiences being in two hot markets, right? North Carolina and Texas, as generalities, right? I understand there's, differences, but those are two states with a lot of, Northerners and Californians and other people coming in for for a lot of different reasons. And then you've chosen Ohio, which, as you say, has suffered economically over the last 40 years of offshoring and all that stuff. So, yeah, could you just shed a little light on the differences between moving from hot, housing markets with a lot of new people and moving to a stable state with a fewer, influx of residents,
Well, thanks, Charles. I appreciate that because it's interesting because we never lost money on any of these houses. And you write about the housing bubbles a lot. And ironically, I mean, I have dumb luck, right? Like I generally have bad luck, but if I have any other kind of luck than bad luck, it's dumb luck. So I've always bought at the right time and sold at the right time with these three houses in the last 15 or 20 years. My math isn't that good either. So I was born in West Baghdad, Virginia, raised in North Carolina. I've graduated from a lot of different schools, colleges, but I also have a degree from the University of North Carolina, Chapel Hill. Chapel Hill is just way too expensive, but Durham, so that's where we bought in Durham, North Carolina. My kids were born at Duke University Hospital. But anyway, so we saw that area growing, and we saw the influx of Hispanics into North Carolina back in the late 90s and in the early 2000s. And we made it our goal. My wife and I making $9 an hour, busted our butts, 2 jobs. We didn't see each other. We ate Cece's Pizza, $2.99 buffet for Friday date night. And we sacrificed for an entire year to scrape and save up the money to put a down payment on that first house in Durham, North Carolina. So that's just kind of one of the things there, because we were a new family, we were newlyweds and all this and that. But in Ohio, in Texas, they were building up Fort Bliss, and I could see that big time. And Fort Bliss went from just a couple thousand soldiers to now it's like more soldiers for the U.S. Army base than any other for a U.S. Army post than any other post in the entire country, population wise. Plus, you got McGregor, which is like for testing all this military equipment, kind of like Yuma Proving Grounds. And so El Paso, Texas is hot in that there's massive federal buildup of the U.S. Army there, in addition to all the federal stuff that goes along with it, in addition to all of the other stuff that comes in to support that. There's like 30,000 soldiers now or something like that on Fort Bliss. So we knew it was fast rising there. And it's funny because they were like, we bought our house brand new that was still under construction from El Paso's best home builder. I'm like, what the heck does that even mean, right? Like, just because you sell more houses than anybody else, that doesn't really mean that it's the best for me, right? It just means I'm probably going to get crappy service. And I remember after we bought the house, they called us and they were like, hey, come pick up your free TV. And I was like, what? And they were like, yeah, your house comes with a free TV. And I was like, oh, okay. So I went and picked up my 40-inch Sanyo LCD TV. But yeah, it's just like, because to me, it's kind of like a graphics card, right? There are no bad graphics cards. There are only bad prices, right? So it's just like you said, right? You need to have a place to live. So there's no such thing as a bad house. There's only such thing as a bad price. So it just comes down to timing and what works out for you, and understanding the larger dynamics that are out of your control that kind of just like say, hey, like with El Paso, we couldn't stand the desert, right? I'm not a desert person. I don't like the desert. And then there's the whole fact that, well, there's no water there. They get their water from Mexico and from New Mexico. And then you can't grow food there. So you got to depend on the supply chains. And then there's so many other things that in 2015, 16, we said, we need to get out of this area because bad stuff is coming. Where are we going to go? We wanted to move to fertile land, something more back east-ish. And that's how we ended up in Ohio after myriad reasons. But I'm rambling and I don't even remember what my initial point was there, but it's just about being nimble and being adaptable, because our last conversation, people thought I was being hyperbolic and people thought you were being hyperbolic with, oh, get out of the city while you can. But the fact is, yes, that's true, but you have to say that because it takes so long to get out of the city if you're not just going to get up and walk out refugee style with a backpack and a suitcase, Charles. So it's like, these things with housing, like you have to be adaptable and you have to be nimble and you have to recognize the larger things that are unfolding to make the best of it. I don't even know if any of that made sense, but does that answer anything with that, Charles?
Yeah, and I think it's just, I think it's interesting that not that many people have moved as geographically diversely as you have. So that's why I think it's, your experience is interesting. Most people have stayed in the same place for a decade or two, or they've moved within maybe 2 states at most, right? So you've already hit 3. So and quite diverse, different environments and cultures and everything. So, yeah, let me talk about housing in sort of the big picture, which I look at, and one is, of course, demographics. Like, how many young people are starting families and seeking to buy their first house, right? So if that's a huge number of people, like the baby boomers in the 70s and 80s, you're going to get a housing boom simply because there are tens of millions of young people who are trying to get a house, right? And so you can build, at the time in the 70s, the US was building about 2 million houses a year, which was pretty quite a bit. And then that dropped off within the last couple decades to like maybe 1 million or so. And now currently it's back up to 1.9 million units under construction per year. So the supply and demand is like what sets the price, right? But part of that is how many people need housing or want a house, how many people are selling, right? And so that's another issue here that's a little different than the housing bubble 15 years ago. Is the baby boomers are older, and I'm one, right? I mean, I'm 68. So there's a lot of churn in the boomer generation as people downsize, or they have to they may be taking care of, like my wife and I, of an elderly parent. So there's, or they might have grandchildren they're taking care of, because, that's another huge demographic change, is that if two people are working and they have young kids, then they need somebody. And either if you're going to pay thousands, that's fine. But if you can't afford thousands, then you tap your grandparents. you know and so all of these things are part of demographics. That's one thing. The other thing, of course, is the cost of money. And so back in the good old early 80s, when the great bull market and the global, the economy started booming, the Reagan years, we were paying about 10 or 12% interest on a house, a mortgage. So that is over, like, roughly double what the rate is now, and it's triple what the rate was a year ago or when you bought, right? Mortgages were like 3.25% or something. So now mortgages have clicked up to 5.25%, and so the payments on a $350,000 house or so have gone from like $1,250 to $1,850. Well, that's up 50%, right? That's not counting the fact that now your house is worth more, so then your property tax is very likely to be higher. Your fire and insurance policy is higher, and so it's not just the mortgage that clicks up; it's everything else related to the value of your home. So that's the big sea change now. That was not the case in the last bubble. Is interest rates are rising, and there's a big debate going on, right? A lot of people say, oh, there's no way that interest rates can stay above zero because, we're heavily indebted and there's too much debt. And yeah, we get that we understand that. But in a long cycle of things, the cycle of interest rates are about 30 to 40 years. And we've had this cycle of lower interest rates for 40 years, from 1981 to 2021. That's pretty much maxing out the length of any interest rate bond, cycle. So others of us, which I think I would say are the contrarians, look at this and go, no, interest rates are going to click higher or stay higher than anybody thinks possible, for a number of reasons, and that's going to have a huge impact on the housing market.
Very interesting. So let's stick on this theme, because you just recently wrote an article, I think it was last week, and a very good article. So check this article out at of2minds.com, which will be in the description below if you haven't already. I can't remember the title of the article. It basically comes down to, is the housing market a bubble that's about to crash? And in that article, and it's funny because we're going to differ on opinion, and this is good because that's what healthy dialogue is about. So in that article, you talking about two schools of thoughts and whether a housing market is going to crash or not. And you were talking about the school of thought that says, no, the housing market is not going to crash, is that the housing shortage is real. And that was the crux of your point there. And then point number two was, yes, the housing market is going to crash because of Fed policy and easy money financial conditions, which have led to a speculative bubble in housing. If I'm not mixing words, you can correct me where I'm wrong here. So there's a couple questions there, Charles. I guess the first question is just for you: is the housing market about to crash? And then the second question would be, well, you laid out 2 points, and you actually hit on the third point that I want to hit on right now, which is, what if there's a third point to consider, a third school of thought, which is this? Well, and this is my school of thought, right? So if the end game is US dollar hyperinflation, then I think that interest rates will be forced back down. So if the end game is US dollar hyperinflation, doesn't it mean that interest rates will be going back down? Doesn't that mean that we'll be getting more debt added onto the pile? Doesn't that mean that we'll be getting more money printing going on? So doesn't that mean also that by extension, housing prices will just continue to rise and then ultimately rise exponentially until outright rejection of the current unconstitutional US dollar? So those are the 2 questions there. You think, the first question, just is to clarify, you think that the housing market is in fact a bubble that's about to crash. That's question number 1. And then question number 2, what if there's that third school of thought, which is if the end game is hyperinflation, then it's going to keep on going up and up and up and up until it does ultimately crash with the outright rejection of the dollar. Thoughts on those 2 issues, Charles?
These are great topics. And my first observation is this just shows how complex this whole topic of housing really is. And so That's what makes it so interesting. And so we're gonna get into these 3 points. In terms of housing bubble popping, I think that financials drive the housing market in particular, because and along with autos or other things that depend on borrowing money, right? And so we have to remember that the U.S. is a neo-feudal society, right? I mean, we claim to have open market capitalism and all that stuff, and we do at a local small level. But at the highest level, the corporations have the money, the pricing power, they have the lobbying, they're the ones that give hundreds of millions of dollars to politicians. And so the top 1/10 of 1% own, the majority of all assets in the US, right? And then the top 10% own something like 89% of all stocks and bonds, and something like 70% of all assets, including F-150 trucks and commercial property, rentals, bonds, stocks, everything. So those people, the top 10%, the people that tend to that the household is making around 250, 300,000 and up, they can afford to buy a house cash. They already have assets they can sell, right? So they are in the cat seat right there. They don't need to borrow huge amounts of money. The rest of us are looking at trying to find a 10% down because we don't have a 20% down, and so we're having to pay a higher interest rate too, because we don't have that cash cushion. We don't have the same credit rating as the rich people, or the people that bought long ago. And let's toss that into the mix too. There's generational inequity here on a vast scale, and it's sort of like impolite to mention it, but let's talk about it anyway because it's the truth. People at my age group, the boomers, everybody that bought a house in the late 70s, early 80s, and they just stayed there. Well, in many communities, they're rich now, not because they were brilliant, they created new jobs. It's like, no, they just got rich because of financialization. In other words, the economy became financialized in the early 80s, and there was a free, huge flow of capital, and then the cost of money kept notching down to zero. And so there was this huge tsunami of debt money, right? Money created by debt, right? And if you look at the numbers, you can see, well, the money supply in the US, the money stock was like 5 trillion, and then now it's like 20 trillion. It's like, oh, well, there's 4 times more money. Are there 4 times more people? No, there's maybe 50% more people. So this wave of money, of course, pushed up all assets, right? Especially as interest rates clicked down. So that benefited everybody that bought 40 years ago or 30 years ago or even 20 years ago. If you bought in 1999, you've done really well in most places. And then globalization kicked in the early 2000s, and that hurt, labor. It hurt wages in the U.S., right? So that's the other thing we have to talk about is if anybody wants to buy a house and they're not already rich, either they already have a ton of cash or they have a house that's worth $1 million, then they need income. And so if income gets crushed or there's a recession and a lot of people lose their jobs, then how the heck is anybody going to afford to make the mortgage payments, right? So we have to factor in, there's a global element to the housing market in the US too. And I think that's a serious issue in that along with the hyperinflation scenario you laid out, there's another scenario, which is the US is the cleanest shirt in the laundry, or however you want to talk about that, and that global capital is pouring in here, and you can see it from like the flood of money out of China. Wealthy people that made wealth in China have been moving for decades into Canada and Australia in particular, right? And they've created housing bubbles in Vancouver, British Columbia, for example, and other Canadian cities. And so if overseas wealth is attracted to someplace, like could be Miami, for instance, wealth from South America and Central America, Mexico, then you get a housing bubble, and it has nothing to do with interest rates or anything. It's just global wealth pouring in and paying cash because they want to live, they want a place in the US because it's safer, and their capital is better treated in the US than it is in wherever they're coming from. So that's part of the complexity. So let me just go back to your core questions though real quick and say, I think we're going to see a bifurcation, like a fragmentation of the U.S. housing market. And that's kind of what I was trying to describe in that long article. I mean, I think it's like 2,000 words or whatever. I mean, and it's like a long article because I was trying to say, if you have communities or counties where the wealthy people in the US and the world find it attractive, you're probably going to see prices continue to go up because there's this huge amount of money that doesn't care about price because it's not related to their income. It's like they're wealthy. And so if you're in one of those places that the wealthy are going into, then prices could keep going up. But if you're in another place, perhaps a big city where jobs are going to start declining and services are going to decline as the cities go bankrupt or run into financial trouble, and then everybody with money is going to flee, and then it's the people with not very much money are going to be left, then you got urban decay. And that's going to be a situation that why would anybody want to pay $1 million for a house in a decaying city? It's like, no, that's not what happens. And people think that's impossible, but they forget that, like New York City, for example, the premier city in the United States, suffered a recessionary semi-collapse in the 70s. It went bankrupt. Services went to hell, and a lot of people left. Right, people that could afford to leave, and then there were vacant buildings that were worthless. It was all jingle. The jingle money or whatever, just people just abandoned them, didn't pay property tax and just walked away. And then the squatters came in, and it was a heyday for artists, right? Because you could rent a flat really cheap. And so there was this sort of renaissance of creative types because they could actually afford to live in New York at that time. So there is an upside to the collapse of prices, in areas, because then it allows people without a lot of money to come in and rent or buy. And I'll give you another example. San Francisco was like, very popular in a counterculture, way in the late 60s. And then it entered a period of steep decline, financial, jobs, everything like that. And so I knew a guy, one of my colleagues in the Bay Area. He bought a house, a beautiful old Victorian in Haight-Ashbury for something like $11,000 in 1973. I mean, it was just like a giveaway. And it had been trashed by, squatters and this and that. And it took him like 10 years to fix it up. And now, of course, it's worth like $2.5 million or whatever. I don't know. Maybe it's $3. I don't know. And so, but it just goes to show that it's all about supply and demand, right? The cost of money is one issue, but if nobody wants to live there anymore, the price is going to collapse. And if everybody wants to live there, the price is going to shoot up. And so that means that, like, say in your case, selecting a place that's going to be appealing and desirable on the fundamentals, never mind the cost of money or whatever, then, it's just a nice place to live, then that's going to probably appreciate regardless of anything else. That's what I'm saying, supply and demand. And the problem that you and I were talking about is America and most of the developed world is now extremely urbanized, right? Like something like 85% of Americans live in cities or suburbs. And so there's these huge concentrations of people in the millions, that are packed into this one little place that is totally dependent on diesel fuel for everything. I mean, the food, the electricity, the trucks bringing in gasoline and everything else. And so you and I look at that and we go, well, systemically, that's not a good thing if energy's going to be in imbalance or there's going to be distortions or disruptions in the energy market. Then, you want to be in a place that's a little more self-sufficient, So that's another factor, is like, where is resilience located, and so some locales are more resilient, some are not. And so I call it, I mention it in the blog, that there's this whole model for how things work. It's called core and periphery. And the core is where the value is and where people want to be, and it's the engine of wealth and all that stuff. And the periphery is where everything's dependent on the core. And when the periphery is what fades and decays and dies, the core will survive hard times, right?
Mm-hmm.
So you want to be in an area that has what I consider core assets, like you said, water, for fertile soil, a productive workforce, et cetera, et cetera.
That's one of the primary reasons for moving to where we moved, because we're close to Lake Erie, we're close to the Maumee River, we're close to Canada, for whatever that even means, just for strategic geographical international relations or whatever. But as far as the core and the periphery, just taking one simple basic concept, the concept of food, right? I look at this area as like a core area of food. When I'm driving around, I can drive around 100 miles in my area and I can see tons and tons and tons of cropland and farmland and just an overabundance of food that says to me there is way more food grown here than the people can eat. So that means that ultimately this core area, just speaking for food and nothing else, is going to survive just fine. But when I think of a place like El Paso, I'm thinking, well, that's, that hand, and that's going to have to get amputated because it's dying and it's going to kill the rest of the body if it doesn't. So am I off on my thinking there? Is that another way to think about the core and the periphery, not just in a sense of wealth generation, but churning it to other things such as like food generation? There's also a core and a periphery, because that's huge talk right now. Empty shelves, supply chain disruption, food shortages, fertilizer prices, energy crisis, all of these things. So if you think about it even in an even narrower sense with that, or am I off of my thinking there, Charles?
No, not at all. And I think that analogy works globally. And that's why I mentioned this overseas demand for U.S. housing. Now, it may be marginal right now. It's not like there's going to be 10 million houses sold, but it's a factor, is that the U.S. is the core, in the sense that we have this immense river system. The Mississippi River Basin is like unique in the world, allows for cheap transport, lots of fresh water, has the Great Plains, has the Ohio Valley. So in other words, these are assets that you can't replace with just money or technology, right? Fresh water, and the U.S. still has quite a bit of energy. And if you combine Canada and the U.S. as North America, there's quite a bit of energy in terms of natural gas alone, not to mention coal and the technology to move to, at least some alternative energy, mix. And so these are assets that are going to be attractive to the rest of the world, because there's just not a lot of extra food, right? And that's coming up now that Ukraine and Russia are going to see like their wheat crops reduced because of the war. There's only like 5 exporting regions of food in the whole world. I mean, for each grain, whether it's rice or it's wheat, there's only 5 regions that grow a surplus that can be exported to the rest of the world. And of course, North America is one of them. And so that is a factor, I think. And people discount that because we're so used to abundance of everything. But abundance is not a guarantee. It's not gravity, okay? It's a set of very fragile, long supply chains, thousands of miles or kilometers long. And if any of those break, then you're obviously going to be much more so resilient if you've got food growing within 50 miles, or you're depending on something 5,000 miles away. That's a different story. So there's that issue. Let's go back to your issue about hyperinflation. I think it's very important. I'm of two minds, about this, because I often write about the American global empire, right? And some people find that offensive, like we're not an empire, but we're a commercial empire, if nothing else, right? I mean, say never mind, we don't occupy other countries, and when we do, that it's always a disaster, and we have to retreat. But commercially, we're an empire. In other words, we have the dominant reserve currency, we have dominant banking and consumer market, right? And so to protect that, you'd have to protect your currency, because if you let your currency go to zero, your wealth vanishes, right? Because everything in your nation is priced in your own currency. So I think there's going to be pushback from the wealthy and the powerful in the U.S. I don't think they want to see the U.S. dollar go to zero, because that means they lose everything too, other than their holdings of gold and silver, right? And physical things like housing. But that doesn't mean that that doesn't mean that that the primary dynamic you're discussing, which is the depreciation of financial wealth and the appreciation of tangible wealth, isn't going to be a factor. In other words, I'm kind of trying to differentiate here and say, just because we might not hyperinflate to zero doesn't mean that we shouldn't account for that dynamic that is the core that you're talking about, which is the devaluation of financial assets, money, and the appreciation of tangible assets, right? Which would be precious metals, real estate, tools, solar panels, you name it, right? And so I think that is a factor. I think that will be a factor. And so I think it's going to be harder to borrow money, despite what everybody thinks. And I think that labor is going to, talent and experience is going to be able to command a premium. And in other words, I think wages are going to go up. The 40-year cycle of interest rates falling is over, and the 40-year cycle of paying people less is also over. People are going to have to get paid more, and capital will have to demand a higher rate of return in inflation. And in other words, let's just touch on that real quick. If inflation is now officially 6.8% or something, let's say 7, and then by some accounts it's 10 or 12%, right? But let's just stick with 7. If you're getting 1% on your money, you're losing 6% a year. I mean, how insane is that? That cannot be sustainable, right? You've got to be able to go back to the way the U.S. economy used to work pre-financialization, which is if inflation's 5%, your mortgage is 6.5%. There has to be 1.5% above real inflation. That's what capital demands. Otherwise, it's losing money. It's losing purchasing power.
These are very interesting points you're making, and this is great, interesting times, very interesting times we're living in. And I know you just wrote a brand new article talking about these themes, and I'd love to nitpick some of that stuff with you too, although that's a topic for another day. For example, I think in your most recent article, talking about gold and gold backed, you're like, well, what is gold backed money? And well, it's not that, I don't know. It's such another interesting topic that I can talk all day about, because to me, it's like, it's not gold backed money. It's just money. It's just gold is the money. It's not backing anything. It is the gold, right? It's the little gold coins and the silver coins. But that's it. But this is like the same side. This is like a different side of the same coin, or I don't even know what I'm trying to say. But you make up a great point, which is actually kind of like the next point that I want to talk about, because in your most recent article about housing, you're talking about all these different dynamics. And one of your main points in your main dynamics is about this rise of work from home, this rise of remote work, online work. You mentioned several dynamics. Another one of the dynamics you were talking about is affordability. And I want to just hammer this point home one more time with Charles, because what you just said about inflation and interest rates and rate of return and all this, it has to do with it and money. Because, that's the crux. That's the question, right? Won't the government, if housing affordability is a challenge, then won't the government at all levels just come up with infinite programs to throw infinite dollars at the problem? Let me give you an example, right? $40 credits for these right here. Now, I don't know if you know what this is, Charles, but this is a old school analog to digital television signal converter. And in the early 2000s, this is the box that it came in, and I've got the box, Charles. And in the early 2000s, I don't know if you can see this little sticker right here, but I'm going to read this sticker, and it says, qualifies for a $40 coupon. So what that was in the early 2000s, when the government forced everybody off of analog and onto digital, they were like, oh, you can't afford that? No problem. Go out and buy one of these converters for $39.99, and we'll give you a $40 rebate from Uncle Sam. So we were like, oh, you can get 2 per household? Heck yeah, we'll get 2 per household. But anyway, so that's an example of throwing money at the problem, even though the government created the problem. But that's an example. Another example is cash for clunkers, right? So that's another example of the government throwing money at a problem. That's all they know how to do is throw dollars, which isn't even money. It's ersatz, money. I don't even want to call it money. It's unconstitutional. It's gold and silver. It's not a choice. It's in the Constitution. But anyway, these are topics for different days. But the point is, the $40 credit for the digital television converters. That's one thing. The cash for clunkers. That's another thing, right? This rebate for electric cars. That's another thing. So my point is the government is going to create infinite programs and throw infinite money at this problem, which is affordability. So who's to say that, there's not going to be like $100,000 to $500,000 home buyer credit or something? Like, what am I missing here? Why are they not just going to keep throwing money at this problem? Of affordability? Or what other dynamics are you looking at that are affecting the housing market right now? Or am I focusing on the wrong dynamics? And help me make some sense of those issues, Charles.
Well, that's a very good point, Paul. And you're absolutely right. The government always refers back to one solution to all problems, which is print some money and throw it around, right? And if you're in a favored constituency, you will get most of that money. And if you're not a favored constituency, you'll be given like a few shreds just so, there's no civil unrest, right? So, and that's actually another injustice here. Let's talk about that. Do renters get these big, subsidies? No, except for specific, low-income housing subsidies. Renters aren't going to be given these kinds of subsidies you're talking about. It's home buyers. Well, not everybody is in a position to buy a house, and so the renters are being just exploited, I have to say, right? In other words, rents have gone up like 40-50% in like a few years. I mean, that's crazy. And so the bottom, 80% of the population, many of whom are renting, are being shafted kind of by this, what I consider fake housing shortage, right? Like, why are rents going up 40%? Is were there really that many people that suddenly emerged, got out of high school or college, and now they need to, they're moving out of the house? I mean, are there that many of them? And of course, let's go back to demographics real quick. Yes, the millennial generation is a large generation, right? 60 or 70 million people, equivalent to the baby boomers. So, but let's also talk about, the things in the demographics. And there's a guy I follow on Twitter called a colleague of mine, Chris Hamilton, and he's into demography. He does all these demographic charts, and he connects age groups with like Federal Reserve interest rates and housing and all this. It's very interesting. He points out that if you take the group of people 18 to 54, in other words, the core workforce population, it's actually flat. It's declining, right? Because the number of baby boomers retiring is so huge that the new workers are simply replacing them. We're not really getting a growing economy in terms of the core workforce. And so his conclusion is this isn't a housing bubble driven by a vast increase in young home buying population. He thinks it's mostly financial because he's looking at the demographics and going, well, the workforce is there. It's stuck at 150 million, right? I mean, that's it. It's not like growing by leaps and bounds. And it's the core. This is the population of young and middle-aged people who are typically home buyers, right? You don't see a lot of 79-year-old home buyers unless they're downsizing, right? So that's another issue here is who's going to be, if we build 10 million houses, who's going to be buying them? And and we talked about location. And so, but to your point about subsidies, I'm sure there will be subsidies, but with housing so expensive, the subsidies would have to be gigantic, right? I mean, and of course, there's a lot of housing subsidies already out there. You're a veteran, that it's not that easy to get a VA loan. You got to jump through a lot of hoops, and a lot of people are so frustrated they just say, "To heck with it, I'm going to go to the commercial market," right? But VA and FHA loans are subsidized in the sense as little as 3% down, right? And so the U.S. housing market already has a lot of built-in subsidies, right? And then there's the mortgage deduction, which, rich people love because they can deduct this gigantic amount of interest and offset their taxes. So those are all subsidies that say renters don't get, And so I think we have to look at these injustices, the generational injustice and the between renters and homeowners, and so how do we solve those? I don't think there is no simple answer, but I want to bring up another point which I find really fascinating, which is the younger generation, people between 20 and 35. Some percentage of them, perhaps small, are going kind of like back to the land. They're acquiring abandoned houses or in rural settings, right? And or they're building a micro house, which I myself did like 40 years ago. I was one of the the early adopters of the whole micro house. I mean, at the time I was like, I don't know, 20, 23 or something like that. Some friend of mine had a couple of acres. And so we built this little 12 by 16 structure. You can call it a shack, but it was well made because I was a carpenter. And when I went back 40 years later, it was still there. I mean, it did eventually get bulldozed because somebody built a McMansion on the property. But I guess what I want to talk about just briefly is the workarounds. What if you can't afford $375,000 or $800,000 or 1.3 million? I mean, it's like the prices in desirable areas are insane. Well, you're going to have to find a place where land is cheap, and maybe you can build a micro house, or you can find a house that's abandoned, or there's some rural counties in the Midwest which are I think I posted a link to an article that are saying, well, hey, you can buy a house here for $1. Now, these are rural counties, so you got to commute. It's a long distance to a major city. But for the right person, like a remote worker, if they have a fast internet connection in that county, then it's like, well, wow, hey, we could, if we can stand the winters in the Midwest, we can get a house for $1. Now it's going to take $20,000 to fix up, or maybe $100,000. But so I'm interested in those sort of like workarounds, as opposed to just kind of saying, okay, I'm going to buy a house in a suburb and make the sacrifices because housing can only go up. And it's all like, well, I don't know. What other workarounds are there?
And those are very interesting points. And I'd like to say, yeah, it's kind of like me. I was an extreme couponer before that was even a term. So you were in the tiny house movement before that was a term. That is awesome, Charles. But yeah, with the workarounds, it's like you were saying, like I think in one of your articles, you're talking about like someone who was a remote from home worker, but also like a part-time remote from home worker, but also a part-time farmer or something. And I'm thinking of that as like, I'm trying to emulate that. And it's like, I just planted all my chili peppers and my tomatoes and my cucumbers and my zucchini and even got some herbs going, like I'm talking about basil and I'm talking about rosemary, those kind of herbs. But yeah, that's like, those are some of the workarounds. Like now I'm on my 3rd season of gardening, and like my goal. So I just realized, what is one of my goals? Well, one of my goals is to never have to purchase a tomato from the store again, right? Just because they're so much more nutritious, they're so much more flavorful, they taste so much better. But I'm not there. Will I be there this year? Probably not, but that's a goal. But the point is, these workarounds that we're talking about, they are definitely viable options, but it's like one of those things where it takes years and years and years to establish these workarounds and get them going, and then to maintain them. I don't think the maintenance part would be as much once you get it going, but the getting it going and then the stumbling blocks along the way and then the hurdles. And I'm rambling again, Charles, but I'm really interested in those workarounds too. In fact, I'm trying to do several of them myself, but I think that's what it's going to take here going forward in the future. You're going to have to do, and like 10 megabits per second is fast enough for work from home, I think. In the United States overall has crappy internet. I'm paying $110 for 100 megabits per second, and it's just 5 up, 100 down, and it's not very good. But these kind of dynamics people have to start thinking about, but not only have to start thinking about it because it's actually probably too late to Well, it's not too late to start thinking about it, but you have to start acting on these things, because these things, workarounds, take years to get established. And there is a high rate of failure along the way, just due to burnout, due to frustration, due to, well, what if the spouse isn't totally on board, right? I mean, there's so many variables that come into this mix. So did you have anything else you wanted to add about just these dynamics in the housing market, Charles?
Well, thank you, Paul. And I know that we've talked about so many different inputs to the decision making, right? And that all these different dynamics are in play, and so it's hard to get a handle on it. You know, it was almost easier back in 2005, 6, 7, 8, when the bubble was rising, and everybody knew it was subprime mortgages that were driving it, right? In other words, you had liar loans, and so guys that made $12,000 were buying, $500,000 houses. And so that kind of speculative craziness was the obvious reason. Now we're talking about a much more complicated picture here. And so I think if we could cut to the chase, right? I think we should say, what kind of life do you want? In other words, you want to choose a house and a location that you like, right? It's not just an investment, although it is an investment, but you want to get in a place where you're going to enjoy life. I mean, and if you're not, and so, and you can say, well, yeah, the spouse has got to be on board, the family's got to like it. Proximity to grandparents and kids, and, there's a lot of different issues, but it's like, I think in a way, once you find a place that you feel comfortable with and that you can swing it, afford it without stretching yourself, you don't want to go to that extreme, it's because there's too many things in out of balance, in disequilibrium, if you will, right now, to make some sort of projections about where we're going to be in 10 years. No, that era is over. Predicting 5 years from now or 10 years ago, hey, I'm not going to make a prediction like that. There's too many things that are massively at extremes of distortions and disequilibrium. So, but if you like a place and you can afford it, then never mind what it's worth, I think. I mean, if you buy it, and you just forget about whether it's going to be worth 5 million or 5,000, because you've chosen it for other reasons. If you want to buy an investment, well, that's a different. I think I would separate out your housing as your investment thing. It's fine to think about that, but that shouldn't be the primary thing, because we don't know what the value is going to be. In your hyperinflationary scenario, every house will be 10 million. And that's possible. Or we get a deflationary crash where there's no more money, no more free money floating around, and then houses that were $1 million go back to being what they were 20 years ago, 150,000. And it's like, to me, that's completely reasonable. It was worth 150,000. Nobody did anything to it. It didn't get 10 times bigger or better. It was just financialization made a $150,000 house worth $1 million. And so for it to go back to 150,000 is that would be just reversion to the mean, just a statistical fact of the way finance works. So we have to think about that too. But if you bought it for whatever it worked for you and you're living in there, does it really matter what it's worth? I'm not so sure it does.
Mm-hmm. Very interesting point. And because one thing is the dynamics and the fundamentals, but the other thing is actually kind of like a question that I wanted to ask, because what you're talking about is, I don't know if you can think 10 years ahead, or I don't know if you think 5 years ahead. And so I was just saying, well, these are kind of like curveballs or systemic shocks coming out of left field. And let me give you just a couple of examples, forced reparations, right? That's actually a thing. Forced reparations in general are actually a thing, right? And it's happening in other countries, and there's a lot of talk about it here. So that's one thing to consider that could abruptly change the housing dynamics in this country. What about I'm not going to say Civil War, because I'm not one of those Civil War kind of people, but for example, Monroe, Michigan, right? That wasn't always called Monroe, Michigan. It was called Frenchtown. And you know why it was called Frenchtown? Well, that's because it was under control of the English in the War of 1812, right? I'm living in all this area that's cursed and haunted from the War of 1812, which nobody knows anything about, but I think is the most important war in American history. But that's not the point. The point is, all of a sudden, one day you're under British rule in Frenchtown, and all the next day you're in Monroe, Michigan. So it's there are systemic shocks that you're not able to plan for that could also affect the housing market. So like, what are there other types of systemic shocks that make this long-term planning impossible? Or am I even thinking in the right way here? Because I know you've also talked about migration patterns or weather patterns or like other things that could be systemic in nature that could affect housing going forward that really negates this long-term type of planning, Charles.
Yeah, no, excellent question, Paul. And you mentioned a lot of them. Let's talk about just like the mega drought in the West. Now, mega droughts are not uncommon. Now, you can debate the cause or whatever, but the historical record is clear. If you go back far enough, there's like 1,200-year droughts or 200-year droughts, and so we don't know whether the mega drought in the Western U.S. is going to end. And so that's a problem because there's only so much water in the rivers and in the aquifers, and so you drain the aquifer, and you fight over the river. There are a lot of ways to conserve water, so it's not like I'm saying that's doom and gloom, but it's like it's going to change the dynamics of population growth because these infrastructures, for example, the Hoover Dam and so on, they were built a long time ago when there was like 150 million people in the US or 100, and now there's 330 million. And some of these places have seen their population expand by tenfold, and yet the infrastructure is the same as when there was only 10% of the same population living there. And so these are issues that are going to really knotty, because you can't create, you can print money, but you can't print water, right? And same with energy, right? You can invest in energy, but the producers have to get enough money to pay for the production. And as the production costs go up, then all of us are going to pay more money for energy. Well, the only thing we can't control how much gasoline is in the gas station, near our house, right? That's out of our control. We can only control how much we consume, and the more you consume of anything, then the more at risk you are of being disrupted, right? If you're using very little and you're not wasting very much, well, then you can get by on less. And so, like long commutes in a big tundra truck, maybe that's going to be something that you don't want to do because that's going to be costing a lot of money, and so you're going to be sacrificing something else for that. So, housing being one of these things, and so we go back to the kind of core and periphery thing. We can't predict finance, definitely. Who knows? It could go either way. Deflationary crash, inflation, hyperinflation, or just stumbling along with high inflation, like stagflation, right? We don't know. And whether in general, the predictions are what's wet is going to get wetter, and whatever's dry is going to get drier. And so, you say, well, I'm not going to make a decision about where to live based on water. And it's all like, well, okay, fine. But also consider these other issues like proximity to food, proximity to energy, and the general economic diversity. And so let's talk about that real quickly. I know we're running up on our hour, but
no, that's fine because but let me cut you off real quick.
Yeah,
so I do want to talk about that real quick, and I want to let you talk about it because I also have one more mini topic I want to talk about too. So go ahead with it, Charles.
Oh, well, just if you're living in a place like Los Angeles or the Bay Area or Seattle or the New York complex, these are like intense concentrations of wealth, and that's distorted those places. So I mean, and I can give you specific stories of houses that are on tiny lots, right on the sidewalk, that were 80,000, and then they went to 500,000, and it's like, do you really want to live there? And it's all like, oh no, but this is all I can afford, And so I think that those dynamics are going to reverse. In other words, that those huge concentrations of wealth have distorted those economies, and to where they're unaffordable for the vast majority of people. And so your only option is to move away. I'm really sorry, but if you can't afford $1.5 million crap shack, well, then you got to find a place that you can afford. And so that migration is going to be a huge factor. And so you want to look at a place with a diverse economy that's affordable to more than the top 5%. And that's really where it is. I just saw a study. The 93% of the population can't afford a house in these urban hot zones.
Now, I like everything that you're saying, and use less, consume less, be more humble. That's a tough sell to the American people, Charles. And then taking it one step further, right? Because this is that other topic I wanted to bring up. One thing that you're saying is absolutely true, but on the other hand, you got to sell that to the American people. But a third dynamic is that, well, the powers that be, and define that however you want, or think about that however you want, but the powers that be, don't they want rising housing prices forever and ever? And aren't they going to fight tooth and nail to make sure that housing prices keep on rising? It seems like there's a lot of reasons why they would want housing prices to keep on rising, right? Some of them would be like property taxes keep going up and up, and government always wants more. They don't want less, they always want more, right? Rising home prices help keep the price of silver suppressed. That's a topic for another day. If the Fed is eventually forced to talk about asset price inflation, well, if they're going to talk about it in a meaningful way, are they really going to be kicking homeowners when housing prices are down? Or are they going to want to have them along in just for dog and pony show saying, see, yeah, we got asset price inflation, but look, your house is up still too. So, and it's rising. Politicians and public servants, well, they have to live somewhere. You hit on this, but I'm pretty sure that, they don't want to have to deal with falling home prices, and much less do they want to deal with their neighborhoods burning down because of riots and civil unrest, right? So it's like there's this massive incentive structure to keep home prices rising, do whatever it takes to keep home prices rising. And what you're talking about is what's needed, but how are you going to sell that to the American people, Charles?
Well, I love your use of the incentive structure. And of course, I use that term too, because it really does define, whatever we're talking about, where are the incentives for and against, right? The disincentives and the incentives. And as you say, there are massive institutional incentives to keep housing prices high. Well, let's look and see what that took to keep housing prices rising over the last, say, 20 years. Well, it took the Federal Reserve as one institution to increase their balance sheet from 800 billion to, like 9 trillion. And they bought a lot of mortgage-backed securities. That's how they suppressed the mortgage rate. They bought over $1 trillion of mortgage-backed securities. In other words, they just soaked up mortgages, and that kept the rates down. So there's been an enormous institutional expense already taken on to keep housing rising, right? But I think that it becomes it becomes impossible when you reach these limits of what we would call diminishing returns. In other words, the Fed has already kind of shot its wad in some way, and you can say, okay, they can print another 9 trillion, but when you get to extremes in these financial markets, then you push it to a new extreme. It no longer works in the same way. It was like the low-hanging fruit on the mortgage tree's been picked. Now, as mortgage rates click higher, who's going to buy these houses that are already overpriced for like the 90% can no longer afford houses in these big cities? So you're running into these limits. Like people simply don't make enough money to pay this mortgage for this $1 million house. And so then what you end up having is, rich people selling their house for $1 million and buying another house for $1 million. But it's like, well, that's just the top 10% trading between themselves. And so you can say, well, there's a lot of buying and selling, but it's all like, no, but the bottom 90% is still priced out. And so you have to have an economy that generates enough good-paying jobs to support housing at the level it's at. And if that falls apart, then subsidies aren't going to compensate. In other words, you'd basically have to be paying people $100,000 a year so that they could afford their $1 million house. And it's all like, well, what's it going to take? And it's like, well, you're going to have to print 15 trillion a year or something. Or 10 trillion. And it's all like, well, how's that? What kind of effect is that going to have on the economy? So I think we're running into financial limits on the free money thing, which, as you say, has been the solution for forever. How do you support asset prices? You subsidize it and you throw out a lot of free money. So if it's no longer free money, then those extremes are going to go away. And so in terms of selling to the American public, it's interesting. You're younger than I am, but so you were just a kid maybe in the oil crisis, the gas line crisis of '73. But people respond, maybe grudgingly, but they respond to reality. And so if energy costs keep going higher and food costs keep going higher and there's a recession and people lose their jobs, well, they're just going to make adjustments, right? And so I'm not too worried about that. In terms of selling it as the way to go, well, I don't know. I can't. I can only say that, there's deep roots in every culture in America about frugality, right? Every culture that has a place in America has a long history of frugality. And so I look at it and say, well, maybe the last 20 years has been this sort of unrealistic expansion of abundance, all based on printing money, as you and I both know. And that once printing money is no longer possible or doesn't work anymore, then there's going to be adjustment where we have to live within our means. And so, and that's not bad. Hey, frugality is not like some kind of punishment. Just means you stop wasting stuff, and that's what makes your economy efficient, right? I mean, so anyways, that's off topic, but yeah, to summarize, housing is no longer an easy decision. That's really what we're talking about. You can't just buy a house for $250,000 or $500,000 and assume it's going to double in price from now on. That would not be a wise assumption to make. It might, or it might not. So you're going to have to include other factors in your decision other than the assumption that housing is only going to double and triple because that's all it's done for 20 years.
So Charles, we've talked about housing mostly today, and I appreciate you having us on. So just the last question is just so I know we've spent this conversation on housing, but just as we're moving through spring, I'm so happy it's spring because got the garden going on, and hopefully my thumb will turn green this year. It probably won't, but I've been trying my hardest. It's the third year in a row. But is housing what's on your radar your most? Or I know you've been writing a lot of different articles. You just wrote the housing one. You've written the one about the money and the just what is money recently. And I know you're hitting a lot of different topics. So what is on your radar the most right now? Or there are a couple things on your radar the most? Or what are you looking at as we move through spring and into summer here, Charles?
Well, I tend to look at the longer picture like you do. And so I guess I'm thinking about self-reliance, which is one of the big topics we're talking about that housing relates to, like where can you live that's, you can kind of have a reliable source of life's essentials, right? And that it's less likely that bad things are going to happen in your locale, right? Self-reliance is one big thing. And I think the nature of work is a big topic for me. I think work has changed dramatically in the last 40 years, and that change is accelerating. And I don't think we really understand it because, we're living in the moment. And so like remote work is one example, but there's a lot of other changes going on in the work environment, which is why 4 or 5 million people are quitting their jobs every month. That's just extraordinary. And so we didn't get to talk about that, but I'm looking at the changes in work and burnout. In other words, the lifestyle many people are leading is not sustainable. So they burn out. They physically run into their barriers, their limits, and then they crash. They can't live with this kind of extreme stress, long work hours, long commutes, and all the stuff that goes into trying to make a living in America at this point in time. So I think people are voting with their feet, and that's part of why what's happening in the housing market is people are going, I can't live like this anymore. I don't want to live like this anymore. What are my options? And that's really that's of interest to me, and that relates to housing, but it's also about work and your environment, and in terms of is it self-reliant, and so those are the issues that are top of my list.
Well, there you have it, folks. Work is important. Housing is important, but most important is doing what you can for yourself and your community and your area and friends and family to try and navigate your way through it. Charles Hugh Smith, I'd like to thank you for joining us again on Silver Doctors.
Thank you, Paul. It was a great discussion.